Meanwhile, the nation faces a lost year and a half of economic stagnation, with migration the only thing preventing the economy from plunging into recession. Modelling by KPMG suggests the number of unemployed Australians will rise to 200,000 over the coming 2 years. Joining me now live is Chief Economist at KPMG, Brendan Rynne. Brendan, good to see you. So 18
Hello.
months of pain possibly ahead. What can Australia expect here?
Look, it's just really going to be anemic growth over the next couple of years. What we're anticipating is that consumption expenditure is really going to be, which represents about 2/3 of the economic activity within Australia, is basically going to be flat. In essence, what we're anticipating is to see that households are going to need to switch their current expenditure from discretionary items to cover those higher mortgage bills, those higher rental payments. And what that means is that overall economic activity is going to be flat or slightly negative as we bump along over the next 18 months.
It's not going to be an easy 18 months ahead. You're also forecasting 200,000 unemployed Australians in 2 years. Take us through the modelling there, and where does this leave the economy?
So the thing to recognise at the moment is that at 3.6%, we got down to 3.5%. We're well above full employment. Full employment usually is regarded around 4.5%. So what we've seen is that Australia's labour market has really just been functioning well above what it would normally do, in essence, because we had our borders shut during COVID. Recognising that what we've got in terms of Australia's labour market is that foreign workers are always our marginal worker. Now, we shut those off for a couple of years and relied on our own population, and that really drove our unemployment levels down to numbers that we've just simply not seen before for quite some time. Now, with the population growth coming back through net overseas migration that's running incredibly hot at the moment, also combining with just a softening within the overall economic environment, we're likely to see labour force or the unemployment levels within the country start to rise as a consequence. But the thing to also know is that unemployment rate is going to move from about 3.6% to around high 4%. So that's still an exceptionally low level of unemployment, particularly when you think about previous recessions where we were getting double-digit unemployment.
You make an interesting point, and you mentioned the pandemic, of course. How does this current economic period compare to that of the pandemic, when businesses were shut, people were being laid off, and there were, not many businesses that were viable at the time?
So many of the government support programs, what they did is that they, with JobKeeper, for example, they underpinned the economy at the time. Arguably, there was probably a little bit too much stimulus that got put in the economy, and that stimulus lasted too long. But nonetheless, what we saw during COVID, and we all can remember, is that there was just huge volatility within that time. So it really depended on whether there were states that were shut down or states that were open as to what the economic outlook was like at the time. Whereas what we're now anticipating is just an overall level of softness within the economy. So growth remains basically at zero. It just sort of bumbles along from quarter to quarter. We've got, and if it's not marginally positive, then it's sort of zero or marginally negative. We are anticipating negative growth in the March quarter of next year. And so whether we get a technical recession in the true economic sense of 2 quarters of negative growth, in many regards, it doesn't matter. We will be in a per capita recession in a sense that we've got this very strong population growth coming through from migration, well above what economic growth is. So we've got growth per capita that's negative. So what that means is households are just going to feel that overall the economic conditions are pretty tight. We're going to see some households where people lose their jobs. We're going to see households where they're having to switch their expenditure from being able to have the nice-to-haves to being able to just focus on the must-haves.
Just finally, of course, rates decision tomorrow. What's your expectation?
Look, I think they'll probably go another 25 basis points. I'd said before when they'd had a pause that actually didn't make a lot of sense to me, that if I was sitting around the table, I would keep going rates until you just don't need to. I think we know where we are at the moment is that we're coming close to the peak, but we also know that we're not there yet. And so given that and the fact that we've still got CPI running well above the target band in either headline or core, then I'd go another 25 basis points and keep going until we actually just don't need to.
Well, I mean, there'll be a lot of homeowners hoping for some reprieve, but it'll be interesting to see what the decision is tomorrow. Brendan Rynne will leave it there. Thank you.
Thanks very much for your time again.